Okay, here's the big question hanging over everything right now. AI. It's exploded so fast, the valuations are, frankly, astronomical. How is this fundamentally different from the dot-com bubble that just, crashed and burned 2 decades ago?
Yeah, it's a totally fair question.
Hmm.
If you lived through the NASDAQ collapse back then, the excitement now, the sheer scale of the money, it definitely has that same feeling, that scary movie vibe.
It really does. Feels like deja vu sometimes.
Absolutely. On the surface, it looks almost identical. You've got the hype, the skyrocketing market caps, just an incredible amount of buzz.
Right.
But the key difference, and this is crucial, the thing that separates this boom from that speculative bubble of 2000, it isn't the flashy app you're using on your phone.
Okay.
The real difference is the heavy, durable, and frankly, astonishingly profitable infrastructure that's been methodically built underneath it all.
Infrastructure.
Right.
Right. So this isn't about hoping some app catches on. This is deep transformation. And that's what we're diving into today. We're going to walk you through the specific data points. I mean, really specific stuff, from NVIDIA's unbelievable 53% net margins to the huge, significant gap in price-to-earnings ratios between 2000 and now.
Yeah, the numbers tell a very different story.
They really do. And they prove, pretty conclusively we think, that this current boom is built on disciplined corporate investment, actual silicon demonstrable enterprise ROI. Not just, speculative hope like last time.
Welcome to the deep dive. This is where we break down the sources, cut through the noise, so you can get genuinely well-informed fast.
Welcome, everyone. And seriously, before we jump in, we just have to say thank you. The response to these deep dives has been amazing, truly overwhelming.
It really has been fantastic. We appreciate all the feedback.
And a lot of you have reached out asking for video content. You want to see the sources, the charts, the data we're talking about visualized. And while we hear you, we're absolutely committed to making that happen.
Yeah, we're actively looking into tools to make that feasible. Specifically, we're checking out the Mosaic AI video editor.
Have you seen that? It's pretty incredible.
It really does. Mosaic seems like a fantastic AI-powered tool. It promises to make life way easier for creators like us. We could just feed it the audio link from this deep dive.
Right.
And it apparently automatically creates great blog posts, video clips, all sorts of useful stuff. It would seriously cut down our manual production time.
Which would be huge. We really want to get a video version of this show out to you.
But here's the thing. To get the funds we need for professional tools like Mosaic, we really rely on this community growing.
Yeah, we need to hit 1,000 subscribers. That's the magic number to unlock some of those resources.
So please, if you haven't already, hit that subscribe button. It makes a huge difference.
And maybe share this deep dive with someone else you think needs to be well-informed on this stuff. Help us grow the channel. Let's, build this new content layer together.
We'd really appreciate it.
Okay, so let's dive in. Let's unpack this central paradox. Is this AI explosion a truly foundational shift? Or is it just another speculative bubble waiting to pop?
Right.
The core thesis we're digging into today, based on the financial and structural data in our sources, is that AI is fundamentally an infrastructure-first transformation.
Infrastructure first. That's the key phrase.
Exactly. Structurally different from the dot-com era, and arguably maybe even bigger in scope than the whole cloud migration that came before it.
Which is saying something because the cloud migration was massive in its own right.
Absolutely.
And what's fascinating, I think, is understanding the critical difference between a speculative bubble, which, is usually driven by consumers, fueled by hype.
Right. Eyeballs, clicks.
Exactly. Versus a fundamental platform shift. That kind of shift starts deep in the back end, often in profitable existing industries.
Okay.
And to really see why AI fits that second category, the platform shift, we first have to precisely diagnose the dot-com crash. What actually went wrong back then, financially and structurally.
Good starting point. So let's set the stage. The dot-com bubble, roughly 1995 to its big peak in March 2000. What drove it?
Pretty simple, really. First, the public was just starting to widely adopt the World Wide Web. It was new, exciting.
Totally new frontier.
And second, critically, the economy was awash in cheap capital. Interest rates were low, especially in 98, 99. That meant venture capital was just flooding into the system, basically backing any company, anything with a .com after its name.
Didn't matter what the business model was, really.
Not really. And that cheap money led straight to the fatal strategic flaw. The whole get big fast mentality.
Ah, yes. Get big fast. I remember that phrase.
Everyone was obsessed with it. Companies just threw strategy out the window and prioritized user acquisition, market share above everything else. Forget profits.
Profits were for later, maybe?
Exactly. Think about the classic flameouts. Pets.com selling pet food online. Or Webvan, the online grocer.
Oh, Webvan. I remember their vans everywhere for a while.
Right. They operated at huge discounts, practically gave stuff away, just banking on this assumption that if they got big enough, built enough brand recognition, eventually, somehow, they'd flip a switch and become profitable monopolies.
It sounds kind of crazy in retrospect.
It was. And that model meant an unbelievable rate of cash burn, just incinerating money.
Mostly on marketing. Super Bowl ads.
Huge amounts on marketing, yes. Those infamous Super Bowl ads for companies that disappeared 6 months later, all driving traffic to business models that were fundamentally leaky, unsustainable.
And investors just went along with it.
Investors got totally swept up in the media hype. Remember Alan Greenspan's famous phrase, irrational exuberance?
I do.
That was it. They completely ignored financial fundamentals. Basic stuff like price-to-earnings ratios, PE, didn't matter.
They just weren't looking at that.
Nope. And that's the key financial failure point. Instead of earnings, they chased these totally irrational, fuzzy metrics, mind share, website traffic growth, things you couldn't really bank.
Sounds flimsy.
It was. And this frenzy drove the tech-heavy NASDAQ Composite Index up. Wait for it, 600% in just 5 years.
600%, wow.
Yeah. And to really put a fine point on how nuts it got, at the peak, March 2000, the average PE ratio for the NASDAQ 100 index hit about 60 times forward earnings.
60 times. So investors were betting it would take 60 years of earnings, assuming they even had earnings.
Right. Assuming they ever got earnings to justify the stock price. It was pure fantasy, just detached from any financial reality.
Okay, so the bubble was inflated. What popped it?
Well, fantasies end right. The Federal Reserve just modestly increased interest rates in early 2000. Nothing dramatic, but enough to tighten that flow of cheap capital.
And the dot-coms needed that constant flow.
Desperately. They relied on constant infusions of new investment just to keep the lights on. Suddenly, their lifeline was cut off.
And the collapse
Was catastrophic.
Right.
The NASDAQ fell 78% between March 2000 and October 2002. Just wiped out. Hundreds of companies vanished completely.
78%.
Yeah.
Brutal.
But here's the critical structural point, the diagnosis. All that innovation, all that investment, it was focused almost entirely on the front end.
The shiny stuff. E-commerce websites, portals, the user interfaces the public could actually see and touch.
Exactly. It was this consumer-facing revolution built on top of a profoundly fragile, underdeveloped backend.
Okay, that makes sense. The infrastructure wasn't ready.
Not even close. Remember the late 90s? Fewer than half of U.S. households even owned a computer.
Right. And internet access was painful. Dial-up modems. That screeching sound.
Agonizingly slow, unreliable. The physical technological reality just couldn't support those lofty front-end promises.
So take Webvan again. They promised grocery delivery in an hour.
Yeah, great promise. But the back-end logistics, inventory management, cold storage for food, optimizing delivery routes efficiently, none of that existed at the scale they needed.
It just wasn't built yet.
Nope. The company failed because the underlying tech, the back end, couldn't reliably deliver on the front-end promise. Simple as that.
And pets.com. The sock puppet.
Oh, the sock puppet. The ultimate cautionary tale of a back-end oversight, wasn't it? The killer was the high cost of shipping heavy bags of pet food.
Logistics again.
Pure logistics. A fundamental back-end operational problem that made the whole business model structurally unprofitable from day one. Didn't matter how great the marketing was, how cute the puppet.
So the front-end dream, fueled by speculative cash.
Couldn't be sustained by the physical, operational, back-end reality. That's why the bubble burst. It lacked a solid foundation.
Okay. So if the dot-com era was speculative front-end on a fragile back-end, how is the AI boom today structurally different? You said infrastructure.
Right. The modern AI boom is anchored by something far more solid. It's being built by established, highly profitable giants who are basically self-funding this revolution.
Established players.
And the data points comparing the two eras aren't just, interesting. They're structurally decisive.
Let's get into those numbers. Profitability first.
Profitability is probably the single most compelling argument for resilience. Remember, at the dot-com peak, maybe only 14% of tech companies were actually profitable. 14.
Wow, that low.
Yeah, today. The companies driving the AI build-out, NVIDIA, Microsoft, Google, AWS, the big cloud players, They aren't just profitable. They are profit-generating powerhouses.
Right. They're already huge, successful businesses.
Exactly. They can fund the next phase of AI innovation entirely from their own massive cash flows. They don't need endless rounds of speculative VC money like the dot-coms did.
And you mentioned NVIDIA's margins.
Staggering numbers. NVIDIA, the key supplier of GPUs, the picks and shovels of this AI gold rush, right?
Is what they call them.
They recently reported a 53.4% net margin. Net margin. That's incredible.
53% of revenue drops to the bottom line.
Basically, yeah. And they're projecting nearly $120 billion in revenue for fiscal 2025. That's roughly double the previous year.
Doubling revenue at that scale with those margins.
These aren't speculative startups burning cash. These are established industrial giants printing money and reinvesting it immediately into more AI infrastructure. It's a completely different financial profile.
Okay, so profitability is way stronger. What about valuations? Because valuations do look high now.
They are high, no doubt, but the discipline is vastly different. Remember the NASDAQ 100 hitting 60x forward PE back in 2000? Pure hope.
Right, 60 times.
In contrast, during the heart of this AI boom, say late 2023, that same metric stood at a much more grounded 26x.
26 times. Still sounds high compared to, say, the broader market.
It is high, absolutely. It implies investors expect strong continued earnings growth, but here's the crucial difference. This time, those valuations are supported by massive, growing, real earnings that are already happening.
So the E in PE is actually substantial this time.
Exactly. Back in 2000, the E was often zero or negative or just a distant dream. Today, the denominator in that PE equation, earnings, is huge and reliable for these key players. It's tethered to reality in a way it just wasn't before.
Okay, that makes sense. What about adoption speed? How does that compare?
Another huge difference, highlighting the fundamental utility. Back in 1999, U.S. internet penetration was still under 50%. Still niche in many ways.
Good while to get going.
Right. Today, by late 2024, data shows 78% of companies globally reported using some form of AI. That's up from 50% just 2 years earlier.
78% of companies. That's incredibly fast enterprise adoption.
Deep, rapid integration into global supply chains, operations. It's not just consumers trying a new website. This is businesses finding real value.
And on the consumer side, things like ChatGPT.
The uptake speed is just unprecedented. Tools like ChatGPT hit 100 million monthly active users within 2 months of launch.
2 months? That's insane.
The internet took years, maybe decades, to reach that kind of global maturity and user base back in 2000. AI is being adopted so fast because it provides immediate tangible value. It's a tool for coding, writing, analysis, not just a novelty or a toy.
So putting it all together, profitability, more grounded valuations, rapid adoption, it changes the whole risk picture.
Completely. The dot-com bust was a crisis of viability. Most of those companies failed permanently. Their business models were just fundamentally flawed, unsustainable the second the cheap money tap turned off.
So let's play devil's advocate. If there is some kind of AI correction or bust today, what does that look like? Does NVIDIA go bankrupt?
Highly, highly unlikely. Today's potential AI bust, if you want to call it that, would likely be, at worst, a crisis of return on investment realization.
ROI realization, meaning?
Meaning the core players, the NVIDIAs, the Microsofts, the big data center operators, they're too entrenched, too profitable to just fail. The risk isn't bankruptcy.
Go.
The risk is that the hundreds of billions they're spending right now on CapEx, on building all this stuff, might not generate the expected level of future returns fast enough.
So the growth forecast might have been too optimistic?
Exactly, which could lead to a significant valuation correction for their stocks. The share prices might come down, maybe sharply. But that's a market normalization, a growth stock downturn. It's not a systemic collapse where the whole sector vanishes, like in 2001.
A big difference. Less catastrophic for the overall economy.
Much less catastrophic. It's painful for investors in those stocks, sure, but it doesn't crater the whole system in the same way.
Okay, so if .com is the cautionary tale, you mentioned the cloud migration as maybe a better analogy, a blueprint for success here.
Exactly. The enterprise cloud migration, moving companies from their own servers to AWS, Azure, Google Cloud, that happened mostly behind the scenes over the last, say, 15 years, that provides the true successful blueprint for this AI boom.
Why is that a better comparison?
Because it was rational, it was ROI-driven, and crucially, it was focused almost entirely on back-end infrastructure and efficiency.
We call it the quiet revolution.
That's a good term for it.
Yeah.
It wasn't a big consumer spectacle. It happened deep inside corporate IT departments. moving core applications, sensitive data, from private data centers to the public cloud providers.
Driven by cold, hard economics?
Primarily, yes. The logic was about efficiency, strategic flexibility. It allowed companies to shift their spending fundamentally.
From CapEx to OpEx.
Exactly. From capital expenditure, big, risky upfront investments in buying servers and building data centers, to operational expenditure, the flexible pay-as-you-go cloud model.
Which avoids having expensive hardware sitting idle.
Precisely. It eliminated the drain of owning and maintaining underutilized infrastructure. That made it a strategic necessity for companies wanting better scalability, performance, agility.
Is there a key example of this?
The classic case study, the one everyone points to, is Netflix's massive shift to the cloud.
Ah, right. What triggered that?
Pain, pure operational pain. Back in 2008, they had a critical database corruption. It completely halted their main business at the time, shipping DVDs for 3 agonizing days.
3 days. Ouch. That must have focused minds.
It totally exposed the fragility of their old system, this centralized, monolithic, on-premise architecture they had built. That failure was the absolute turning point. It forced a complete strategic rethink.
So they didn't just move their existing stuff to the cloud.
No, and this is key. They resisted the temptation to do a simple, lazy lift and shift, just moving the old, flawed architecture into AWS.
Right.
Instead, Netflix undertook this deliberate, difficult, 7-year cloud-native rebuild. 7 years.
7 years. That's a serious commitment.
Huge commitment. They broke down their monolithic application into hundreds of independent microservices, all running in the AWS cloud. It wasn't just a tech upgrade. It required fundamentally changing their entire engineering culture, how they develop software. Deep, internal, structural change.
And the payoff.
Staggering results. During that long 7-year migration, think about this, their streaming viewership grew by 3 orders of magnitude.
1,000 times while migrating.
1,000x growth in viewership.
Yeah.
And their global subscriber base grew 8 times over that same period.
Wow.
The sheer agility and scalability they got from that cloud backend, that was the absolute non-negotiable foundation for them becoming the global media giant they are today.
So the goal wasn't just saving money on servers.
Cost savings were nice, sure. A welcome side benefit, as they put it. But that wasn't the primary driver. The main goal was superior capability, superior agility, the ability to scale globally.
That makes sense. Capability first.
And this whole cloud story leads us directly to why the AI boom is so robust now. There's a clear technological lineage here.
How so?
Well, the AI boom isn't happening in isolation. It's the necessary next step, built on the foundations laid by previous eras.
Okay, connect the dots.
Think back to the dot-com era. For all its financial failures, it left one huge positive legacy. Massive overinvestment in fiber optic network.
Right, all that dark fiber they laid.
Exactly, which eventually drove the cost of bandwidth way down, leading to cheap, abundant global connectivity.
Which the cloud needed.
Absolutely critical enabler for the cloud migration. Then the cloud itself consolidated computing into these massive, hyper-efficient data centers, AWS, Azure, GCP.
Democratizing supercomputing power, essentially.
Pretty much, yeah. Making immense compute power accessible to almost any business, anywhere.
And now AI comes along.
And what does modern AI desperately need more than anything?
Massive compute power and data storage.
Exactly what the cloud provides. Massive, scalable, on-demand compute and storage for petabytes, exabytes of data. The AI boom, at this scale and speed, it would be literally impossible without that cloud layer already being mature, efficient, and globally deployed.
So AI is built on the cloud, which was built on the cheap bandwidth from the dot-com era's overinvestment.
You got it. It's standing on the shoulders of giants, or at least on the shoulders of previous infrastructure build-outs. That makes it inherently more structurally sound than any tech boom before it.
Okay, that's a compelling lineage. So let's get into the core of the current AI revolution itself. You're framing it as the next great back-end shift.
Right. If the cloud was about shifting computation to a utility model, AI is about embedding intelligence and efficiency into that utility. And it's transforming the whole tech stack in, I think, 3 critical layers.
3 layers.
Yeah, and crucially, all 3 are overwhelmingly focused on back-end capability and generating measurable ROI.
Okay, layer 1.
Layer 1 is the silicon foundation, the hardware. This is the purest picks and shovels part of the build-out.
GPUs, TPUs?
Exactly. AI workloads, especially training these huge models, are all about parallel processing. Specifically, tons and tons of matrix multiplications. That's the core math.
Which regular CPUs aren't good at.
Hopelessly inefficient for it. Hey, I need specialized silicon GPUs from NVIDIA, TPUs from Google, various custom ASICs designed for massively parallel work.
And the demand for this specialized silicon is huge.
Massive. It's the non-negotiable hardware necessity driving the whole semiconductor industry towards becoming potentially a trillion-dollar industry by 2030.
$1 trillion just for chips.
That's the trajectory. But what's really fascinating here is that AI isn't just the product being run on the chips. AI itself is now a critical tool in designing the chips.
How does that work?
AI tools are being used to accelerate complex chip design times, taking processes that used to take months down to hours. They can optimize the physical layout of billions of transistors on a chip for better performance, lower power consumption.
Wow, AI designing AI chips.
It's happening. And it extends to manufacturing, too, using AI to improve chip yields in the fabs, predict equipment failures before they happen.
And you stressed earlier, this investment isn't speculative.
Look at the strategic partnerships. Google and Broadcom have been co-developing Google's tensor processing units, their custom AI chips, for years now, through multiple generations.
Right, the TPUs.
That partnership represents billions of dollars in highly targeted, non-speculative R&D. It's aimed purely at creating bespoke, tightly integrated backend hardware optimized specifically for Google's internal AI needs.
So not like throwing VC money at a startup with a vague idea.
Not at all. This is the modern equivalent of building the railroads or the electrical grid in the early 20th century. It's foundational industrial infrastructure investment. Hugely expensive, but strategic.
Okay, that's the silicon layer, layer 2.
Layer 2 is the process revolution. This is where AI gets embedded into core business operations, often the boring, non-glamorous stuff, specifically to drive measurable ROI.
So same logic as the cloud migration, but for processes.
Exactly the same rational economic logic. Moving from CapEx to OpEx was about efficiency. Now AI is enhancing human and mechanical processes for efficiency and effectiveness gains.
Where are the biggest gains happening here?
Mission-critical back-end stuff, supply chain, manufacturing, logistics. AI is optimizing delivery routes for trucking fleets, cutting fuel consumption. It's improving inventory management dramatically.
How dramatically?
By reducing forecast errors by, get this, 20% to 50% in many cases.
20 to 50% reduction in forecast errors. That's huge for managing inventory.
Massive. Cutting forecast errors in half means lower carrying costs, fewer times you run out of stock, much healthier cash flow. These aren't flashy consumer apps, but they drop directly to the company's bottom line.
Which drives adoption.
Absolutely. It's leading to a whole new wave of what's called business process reengineering, or BPR. Basically, companies fundamentally rethinking and redesigning how they do core tasks.
Using AI for automation.
Deep automation of high-volume, repetitive tasks. Think invoice processing, data entry, handling customer service tickets, even employee onboarding.
And companies are actually doing this.
The data shows strong adoption. Around 70% of enterprises report high adoption rates specifically for process automation using AI. Why? Because the business case is just so clear and compelling. Fewer errors, lower labor costs, faster throughput. It just makes financial sense.
Okay, silicon process. Layer 3.
Layer 3 is the development stack itself, how software is actually built. And here AI is proving itself to be inherently a back-end first technology.
Back-end first. Interesting. Why?
Well, think about AI coding assistants, tools like GitHub Copilot. They excel at the structured, logic-based tasks you find in back-end development, generating reliable database schemas, writing efficient, secure API endpoints, optimizing complex SQL database queries. The backend tends to be very logical, structured, rule-based. AI handles that beautifully.
But not so good at the front end, the user interface.
It struggles there, relatively speaking. AI has a much harder time with the subjective, aesthetic, nuanced requirements of really good front-end development.
Making things look good and feel intuitive.
Exactly. It can generate basic UI elements, sure, but it often lacks the polish, the intuitive user flow, that human touch that a skilled designer brings. It reinforces AI's identity, for now at least, as this infrastructure-first, data-handling logic engine.
A brilliant plumber? Maybe, but not yet a brilliant interior designer.
That's a great analogy, actually. Yeah, it's fantastic at the pipes and wiring, less so at the paint colors and furniture arrangement.
And does the money follow this? Is investment skewed towards the back end?
Overwhelmingly. Projections show spending on AI back-end networks, The GPUs, the interconnects, the data centers, all that specialized hardware is likely to exceed $100 billion over the next 5 years.
$100 billion on the back-end infrastructure.
Yeah, and that absolutely dwarfs the investment going into purely front-end AI applications right now.
So that gives us the final contrast with .com.
Exactly. AI today is an infrastructure-rich, application-in-progress environment. The foundation is powerful, stable, already being built by profitable giants.
Whereas .com was.
Vision-rich, infrastructure-poor, all front-end dreams, flimsy backend. That structural inversion is key to why today's AI boom is much more resilient against a total systemic collapse.
Okay, this back-end heavy structure points towards a different kind of financial future for AI then. More stable.
More durable, I think is the word. The demand driving this is fundamentally different.
How so?
Because AI is solving concrete, complex, measurable business problems like reducing manufacturing defects or making software development cycles faster and cheaper, the demand is tied into long-term corporate IT budget cycles.
Not just consumer wins.
Exactly. It's anchored in multi-year strategic planning by large enterprises. That makes it far less susceptible to short-term market sentiment swings compared to, say, a new social media app.
And the picks and shovels players provide stability.
They act as the market's anchor, yeah.
Yeah.
NVIDIA, Broadcom, Microsoft, Google, these infrastructure players are cash-generating behemoths. They're funding their own growth. We mentioned Broadcom's TPU deal with Google.
Right, $10 billion in revenue projected for 2025 from that alone.
Just from that one custom chip program. In the dot-com bust, remember, many of the supposed market leaders were themselves unprofitable, totally reliant on external capital.
So when the capital dried up,
they collapsed and it dragged the whole system down. Systemic failure. Today, the market leaders are the main source of capital, constantly reinvesting their huge profits back into the ecosystem.
a self-funding mechanism.
Right, which helps prevent that kind of cascading total collapse we saw in 2000, 2002.
Okay, but let's be real. It can't be all smooth sailing. There must be risks, right? Some froth.
Oh, absolutely. We have to acknowledge the risks. There are undeniable pockets of speculative froth out there.
Where specifically?
Particularly in venture capital funding for certain types of AI startups, especially maybe pre-revenue generative AI application companies, the ones chasing that next killer app.
Is there data on that VC funding?
Yeah, pretty startling data, actually. In the first quarter of 2025, an extraordinary 58% of all global VC funding reportedly went into AI companies. 58%.
Wow, more than half of all VC money worldwide.
Into AI. That level of concentration definitely suggests some serious FOMO, fear of missing out among VCs. That feels bubbly.
Okay, so VC froth is one risk. What else? Macroeconomics.
Macro headwinds are definitely a factor. We're not in the zero interest rate world anymore that really fueled the big cloud boom.
Right, rates are higher now.
Higher borrowing costs inevitably make these huge capital-intensive build-outs, especially data centers, more expensive. That could slow the pace.
Makes sense. Any other major risks?
Regulation is the other big one. There's still a lot of uncertainty. You've got the EU's AI Act trying to set comprehensive rules, various executive orders in the U.S. How these regulations get implemented and enforced adds a layer of operational risk and cost.
So summing up the risk, a correction is possible, maybe likely, in the frothy parts.
A painful correction in those speculative subsectors seems highly likely, yes. But the profitable foundational core of the boom, the infrastructure players, the enterprise adoption that looks much more resilient.
Okay, let's pivot finally to the big picture. The macroeconomic impact. How does this AI build-out affect overall GDP growth?
This is where it gets really interesting, and it further distinguishes AI as a genuine industrial shift. Its impact on GDP seems to come through two main engines, operating sequentially on different timescales.
Two engines. Okay, engine number one.
Engine one is capital expenditure, the short-term stimulus effect. All this massive, global, building new data centers, servers, specialized chips, upgrading the energy grid, that's a direct, immediate injection into the economy.
Like a construction boom, basically.
Exactly. And it's already showing up in the numbers. Estimates suggest AI-related CapEx added about 1.1 percentage points to U.S. GDP growth in just the first half of 2025.
1.1%. That's huge.
It actually outpaced the American consumer as a single driver of growth during that period. Globally, the hyperscalers, the big cloud companies, are projected to spend over $340 billion in 2025 alone on this stuff.
$340 billion. Wow.
So that's a powerful front-loaded economic shock. But it's temporary, right? You only build a data center once.
Okay, so CapEx is the short-term boost. What's engine number two?
Engine 2 is productivity gains. This is the long-term sustainable trend. This is what happens after the infrastructure is built, and AI gets deeply integrated across all sectors of the economy.
Driving efficiency.
Driving what economists call total factor productivity, or TFP. TFP is the ultimate measure of economic efficiency, how effectively we use labor and capital, getting more output from the same inputs.
And why is that so important?
Because rising TFP is the key to sustained long-term wealth creation and higher living standards. And for decades now, productivity growth in advanced economies has been disappointingly slow. AI has the potential to actually reverse that trend.
So engine 1 is the build-out boom. Engine 2 is the long-term efficiency dividend.
Precisely. And this dual-engine model helps us make sense of the different forecasts we hear about AI's GDP impact.
Right. Some forecasts sound incredibly optimistic, others more measured.
Exactly. When you hear really high numbers, like, say, OpenAI's reported projection that the first $1 trillion invested could boost U.S. GDP by over 5% within 3 years.
That sounds huge.
It is huge. But they're likely primarily measuring the temporary front-loaded surge from Engine 1, that massive capex shock from construction and hardware deployment. It's the boom phase.
Okay, and the more conservative forecasts.
When you see more conservative numbers, like maybe from the Penn-Wharton budget model, projecting something like a 1.5% level increase in GDP by 2035.
Much smaller number.
Right. They're modeling the slower, gradual, but enduring impact of Engine 2, the TFP growth, that happens once AI tools are fully integrated into business processes across the economy.
So they're not contradictory forecasts?
Not necessarily. They're likely describing sequential phases. You get a short, sharp burst of high growth during the build-out, Engine 1, followed hopefully by a new, higher sustainable growth rate driven by genuine productivity gains, Engine 2.
That makes a lot more sense. Build first, then reap the efficiency benefits.
Exactly. And finally, we can't ignore the sheer physical reality of this build-out. This isn't just software in the cloud. It requires immense real-world infrastructure.
You mentioned energy earlier.
Yeah, the power demands are staggering. Current estimates suggest we might need up to 100 gigawatts of new power generation capacity globally just to run all the AI data centers being planned.
100 gigawatts. How much is that?
That's like building dozens and dozens of large new power plants, a massive undertaking for the energy sector.
And what about labor? Does it create jobs?
Absolutely. And crucially, it demands traditional industrial skills. OpenAI's own analysis suggested their build-out alone would require the equivalent of 20% of the entire existing U.S. workforce of electricians, mechanics, and other construction trades over the next 5 years.
20% of those trades, just for OpenAI's plans.
That's what their analysis indicated. This isn't just a digital bubble benefiting Silicon Valley VCs. It's fueling a genuine industrial boom and energy renaissance. It requires welders, electricians, construction workers on a massive scale.
Creating a durable economic multiplier effect.
Exactly. And that is the true hallmark of a foundational platform shift. Not just a speculative tech fad. It has deep roots in the physical economy.
Okay, so pulling it all together. The verdict: bubble or foundational shift?
Based on the structure, the finances, the backend focus, the enterprise adoption, the productivity potential, all the evidence we've looked at today points strongly away from a 2000-style speculative bubble.
It looks more like?
More like the rational, profitable construction of the next industrial backbone, driven by disciplined economics, anchored by profitable giants, built literally from the silicon up. It just seems fundamentally and structurally sounder than the tech booms that came before it.
All right. That's a strong case. So here's a final provocative thought for you, the listener, to maybe chew on after this deep dive.
Go for it.
If the foundation, the infrastructure, the silicon, the mass compute is already so powerful and it's being built out at this historic rational pace, what truly revolutionary applications are we still waiting for? What's going to fully utilize all this unprecedented intelligence?
Good question. The back end is getting ready.
The back end is getting ready. But maybe the next era of truly killer apps, the ones that really transform the consumer and front-end experience in ways we haven't even imagined yet, perhaps those are still to come.
Something to think about. What will run on this incredible foundation? And before we sign off, just that final quick reminder from us.
Yes, we are genuinely excited about trying to create video content for these deep dives.
We're looking seriously at tools like the Mosaic AI video editor. It looks like it can make it super easy for us. Just feed it the audio link, and it helps create beautiful video versions, blog rolls, all that visual context you've been asking for.
It sounds fantastic. But as we said, we really need your help to unlock the funding to get tools like that. It's all tied to our subscriber cap.
Yeah, hitting that 1,000 subscriber mark is key.
So please, if you found this deep dive valuable today, please hit that subscribe button, share it with your network, spread the word, help us get there so we can bring you the video content you deserve. We really, really want to do videos.
We really do. Okay, until next time.
Keep listening to Lagina songs.